officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and number 4, because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And our amazing community manager. She's a Celtics fan, but we still love her because she brings us the moments that matter. We call her MTM, the moments that matter. Mm-hmm. We call her MTM because she is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And, if you're joining us live here on YouTube, you're popping in on the podcast, you're watching for the first time, or maybe you're here for the first time in the live audience. We have done something for you. We have put together a class called the Not Your Average Investor's Guide to Investing in Real Estate. We're giving it away for free right now so that you can catch up on all the inside jokes that happen in the community. Just get up to the level of real estate knowledge so you can make your best decisions. You can just be a part of what we do here and just ramp up from 0 to 60. And now you can ask the advanced questions, but we still love whatever questions you got going. It is free until the end of June. If you go to, you want to tell them the websites because I've already messed everything up.
Yes, you want to go to nyaiclass.com, nyaiclass.com. When you get there, you want to put in a special promo code. Now, not all of you have been putting in the promo code. Some of you have just been spending the money on the course. We don't want you to spend the money right now. We just want your feedback. So you have to put in the special promo code, which is NYAI Guide Free. NYAI Guide Free. If you put that in, you will not have to pay anything. It will cost $997. And it's been kind of cool to see that some folks have actually paid for it, even when they weren't supposed to. We know that it's going to sell for that. But don't be like one of those folks. Just put the promo code in there, get it for free. And we want your feedback, especially here in the Not Your Average Investor community here. We love you guys, and you guys are here in full force every single show. So we're happy to invite you to be a part of it. We just ask for your feedback.
All we want is a little bit of feedback. And again, nyaiclass.com. And when you go to sign up, what's going to happen is like at the end, there's a little thing that you put in coupon code.
Right.
It opens up the field and you put NYAI Guide Free. Madison's going to share it in the chat right now. Free till the end of June. As GC kind of alluded to, it's $1,000 course that we're giving out for free right now. Mm-hmm. Feeling pretty good about the value of it, especially for free.
I don't know if it's free till the end of June. I don't think it is. I think it's free for 30 days. So I don't know exactly when it's not free anymore, but it's free for 30 days. So either way, just go and get it right now. I see.
So that being said, once you jump into that class, you're going to want to be a member of the community and you're going to be ready to like chime in with the genius thoughts. And you're also going to be ready to chime in what you see.
The roll call, baby.
We got Christopher Lee from Fernandina Beach checking in. We got the fairy godmother of the Not Your Average Investor community,
Jen Filzen.
Jen Filzen checking in from Monterey, California. We got the leadoff hitter batting third today,
John Henning.
John Henning. We got our regulars, the second family of the Not Your Average Investor community, Gary and Rosalind Riley from Murrieta, California.
We salute you.
We got the ringmaster, who is a Florida man now.
He's a Florida man?
Yeah.
Oh, he lives here. Yeah. But he's an FSU guy. I thought you were talking about college. Yeah. Drew Barnhill, welcome to the show.
Trying to compliment him like University of Florida, man. We got the early bird in the house from Columbus, Ohio.
Dean Curry.
We got Carly Becker in the house.
All right, Carly. Nice to see you.
Is Carly, I feel like you've been here before, not a regular. Great to see you checking in. Love it. A man who is certainly a regular from the West Coast with a trademark. Good morning, good afternoon, JWB.
Mr. Nadeem Shah.
Mr. Nadeem Shah. We got Big Papa in the house. We love it when he calls in Big Papa.
He calls in Big Papa.
Gregg's dad, Jay Cohen in the house. We got Amy Matthews, the late night after party karaoke friend of ours.
She witnessed
what it was. We got the first family of the Not Your Average Investor community in the house, the matriarch and patriarch Ken and Carolyn Moline. We salute you. We got Layla Powell in the house. Good to have you. We got Feliz Martes, Damas y Caballeros from
Bill Shields, of course.
From Bill Shields, who likes to call in with his we got Right Along Raj in the house,
right.
Checking in with us, saying hello all. We got Bob Wiesner in the house from Casablanca, Morocco. Oh man, that's a beautiful place.
Wonderful.
I want to be checking in on vacation. We appreciate you, Bob. Who else? We got the man that everybody knows from California.
Noah Randari.
Noah Randari checking in. We got our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Aaron, my condolences for your Boston brethren over there.
It's been a tough year for Boston fans.
It's a tough year.
We heard a lot of trash talk from Erin when she was talking about the Bruins. I'm sure she was talking trash about the Celtics.
It's been tough. We got Sergio Pareto in the house. Go
Gators.
Who else we got? Oh, we got Pedro Nacianceno checking in from Jersey. I'm guessing because he checked in from his text. If you check in from the text, it has you as not your average guest. You can change the name in the chat, or if you have a trademark greeting, we will recognize you.
There you go.
We got teammate Tanner in the house.
Love that.
Charles
Welcome, Tanner.
Good to have you here. We got Marilyn Cotterman. She's from Homosassa, Florida.
That's the home of the manatees, Pablo.
Home of the manatees,
Yes,
where the
it is.
manatees swim with humans. Good to have you, Marilyn. As always, Sergio Preto, fellow Heat fan. Good to have you. And Terry Ingram is back from Orlando.
All right,
Good to have
Terry.
you, Terry. All right, GC, let's dive into this show when it comes to timing the market.
Yeah.
If I am somebody that is got all my money in the stock market and I'm thinking about making a move into real estate, does it make sense to time the market right now? Like, what is happening in the market that, you know, I may time it, I may not time it. What do I need to know about that?
Yeah, you know, I think I could really give a convincing argument that timing the market right now in the short run is the thing to do. But I deep down, I really don't believe the timing the market. I believe in finding an asset class that is better and then making sure that I have my assets there. And then I also believe in looking at my total portfolio and thinking about, do I have way too much of my total portfolio in one asset class versus another? So listen, I could really throw some stats at you, and maybe I will when it talks about how the stock market does in pre-recessionary times and recessionary times, and compare that to real estate and how does that perform in recessions, which we can certainly go into that. But I don't want to get into this market timing as being the reason type of conversation, even though it's easy for me to give that information.
It is easy right now.
Because at the end of the day, what I'm going to be telling you guys 1 year from now, 3 years from now, 5 years from now, 10 years from now is the same thing I've been saying for the last year, 3 years, 5 years, 10 years, 17 years that I've been investing, is that you should understand which is a better asset class, first of all, right? Which has a better internal rate of return over the long haul. And then in addition to that, look at how much of your pie is in one spot, because I don't think it's good for all of your pie to be in one spot. And for most of you, when you ask those two questions, it would lead you to leave some of your assets, to move some of your assets from the stock market into real estate, but not just because I think the S&P is going to go down in the short run.
Gotcha. So let it be clear, GC is not a timing the market guy.
I'm not.
If you hadn't figured that out already. That being said, I'm going to challenge him to really think through this a little bit. So let's talk about proper conditions. Well, first of all, you said one returns over the other. Tell us what you believe, you know, like give us the difference in the risk return, or, you know, kind of like outlook of rental properties versus stock market.
Yeah. So I did the data on this, and we've shared it on the show a couple of times, but especially for the newer folks, you know, I actually ran the numbers over the last 20 years. If you invested $35,000 in the S&P 500 and you invested that $35,000 in a rental property in Jacksonville, and I said, well, which would have had the better internal rate of return? Which would have had the better return on investment over those past 20 years? And for the record, this has not been the best 20 years in the history of real estate in Jacksonville, by the way, because that 20 years took into account the Great Recession, right? Which saw values actually drop during that time, one of the only times on record. But all of that combined, looked at the S&P, which had a pretty good run, right? Looked at real estate, which had a real negative run and then has rebounded. At the end of the day, a Jacksonville investment property outperformed the S&P 500 by 44%.
Okay. So, and that was
44%.
Yeah. So outperformed by 44%. That is, what is the actual like number? It's like the stock market was like 8% and Jacksonville property.
Yeah, I think it was 9.7% for the S&P 500. And, you know, I think it was 13 point something percent for Jacksonville rental properties.
Got it. So that is the in a vacuum. This is how it performs over like a full market cycle, historical average. So despite timing the market or not timing the market, that's what we see. Now let's talk about today, this day and age, stocks versus real estate, timing the market. I'm looking at this thing right now. Is it a good time to invest? What would make me think one way or the other in timing?
All right. So you're going to force me to look in the short run.
Yes.
And just force me to do that.
You have already told everybody you're not a
Does
timing the
everybody
market
realize
guy.
that I'm not a timing the market guy? I don't know if I've said that enough yet.
I know.
But if you force me to be a timing the market guy, here's just some stats to consider, right? The S&P 500's performance over the last recessions, I don't know how many there have been, I think there have been 12 recessions since World War II. The average performance for the S&P 500 in a recession is a loss of 29% of value. The best the S&P 500 has performed in any recession since World War II is a 20% decline.
Okay.
We're not in a recession yet.
Yeah. But there's all sorts of wacky stuff going on that people have been saying there's a recession coming. It almost reminds me, honestly, man, it reminds me of, I hate to bring it up, but our last recession was a long ramp up of like, there's something coming, and people are like, yeah, it's coming, it's not coming, blah, 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 right? Like, I felt like there was a lot of talk about that there was a bubble, stuff was going to happen in the overall economy in our last recession. And it just it took longer than we thought. And when it happened, it happened.
Are you talking about the great financial crisis?
I'm just talking about the last one that we all lived through, right? Like it was 2000.
You're not talking about the pandemic, which was a weird.
No,
weird
the pandemic is a completely different thing, right?
Yeah.
Like I just mean that if you look at it in hindsight, right? Like I've talked to you about it. You were in the real estate world. You were like, nobody was talking about it dropping because you have a different lens on it. Me in the construction world during that time in Fortune 500, doing my quarterly projections for my division and my P&L, it was always like, hey guys, we think something's going to happen. Hey guys, we think something's going to happen.
You remember that chat? 05, 06, 07.
That chatter started in 2006.
Yeah.
And like it got louder in 2007 and all of a sudden something happened, right?
Yeah.
So to me, I feel like we've been kicking the can down the road of like, there's a recession coming. After a little while, you start kind of becoming deaf to it. It just becomes chatter in the background. But the reality is that there's some real indicators that all this, the Fed's been doing this stuff. We've had this war. We've had this shortage of prices, all these different things that are happening. And everybody keeps talking about there is a recession coming. And at some point it's going to happen.
It becomes a self-fulfilling prophecy. You got Jamie Dimon and all these other big thought leaders in the financial world, saying this for many, many years. Yeah. And I think there's a little bit of, well, they've been talking about it for so long, so maybe it's not going to happen. But what people fail to realize is when the Fed makes actions like interest rate increases, it doesn't affect the economy like that, right? It takes 6 to 12 months for the effects of interest rate rises to actually affect the economy. And we haven't raised interest rates to this degree, this fast since the 70s to the late 70s, the early 80s. So it's been 40 years since we've risen interest rates this way. So the impact has yet to be seen. It's been about a year now since we first started interest rate rises, right? It's been 10 months of interest rate increases. So over the next 10 months, you should start to see more and more of the effects. And oh, by the way, the effects that we have seen from these types of interest rate increases, those should be substantial. Right? It's not so surprising that we haven't seen the recession yet, but don't let that confuse you that we probably have some challenges coming our way as an economy, because that's what the Fed needed to do. They needed to raise interest rates to cool down the economy. And, none of us want a recession, but most likely that's going to lead to one.
Yeah. And you just kind of said it, right? Like, so the best that the market has done during a recession is a drop of 20%. The average is a drop of 29, is that what we said? A drop of 29%, right? So if you're thinking about timing the market, if you are in stocks, it is reasonable to expect somewhere in that range of that behavior to happen when this recession hits. What about real estate? How does real estate perform in a recession?
Incredibly consistent. So many people don't realize this, but US rents year over year have never gone down in any recession. In any other time too. US rents have never gone down year over year on record. It is incredibly rare to even think that they may go down, right? In an individual market, maybe they went down a little bit here, a little bit there, but overall US rents have never gone down. It's an incredibly consistent asset class, save for the Great Recession, which was a unique time period, which was caused by the real estate market and caused by the lending world. Save for that time, prices in Jacksonville have never gone down on record, right? It is an anomaly that house prices went down, not the norm. So you think about housing prices and housing rents, incredibly consistent, right? So the idea of moving money from the stock market to real estate is, listen, over the long haul, stocks are going to do just fine too, right? They're going to rebound, right? The stats that I'm giving you are just during a recession, right? It's not over a full cycle. So I believe that stocks will rebound, and over the next 20 years, you'll still make whatever, 9% or 10% on your portfolio in the stock market. But what I think is, if you're somebody who has all of your wealth in the stock market, regardless of what should be happening in the short run and the long run, you should analyze that. You should think about that, because that's not good, right? You should probably have that in different asset classes. You should probably have some of that, a significant portion of that, in real estate, an asset that is way more consistent, that you don't have to go and check the stock ticker to see how you're doing, that your quality of life is not nearly as at risk because of a drop in 30% in value, overnight or something along those lines, which we've seen many times in the stock market. You don't see that in real estate. So at some point, if you've got all of your chips on the stock side and in stocks and bonds, you're probably looking for an avenue to get it into a more consistent asset class. Well, consider this a great time to reanalyze that, right? Regardless of what's happening in the short run and the long run, it's probably good for you to move it into a consistent asset class. What better time to move it into a consistent asset class that at the same time is facing some tough times based on historical performance during recessions?
Yeah. And I think that there is something to clarify here. I guess I don't believe that all real estate is built equal, right? Like I would assume that commercial office space, yeah, but the asset class in general that we talk the most about on this show, which is workforce housing, cash flowing rental properties, you had the experience over the Great Recession that even during that time when the stock market was way down, where real estate lost value, as long as on the front end, you are buying something that is at least break even or slightly positive in cash flow with a great team that's going to manage it, you are able to ride that thing out while maintaining your cash flow, while preserving your capital, right? Like minimizing the loss of any kind of capital, maintaining your cash flow, right? Like turning your equities into income. And I guess back then inflation wasn't a big deal, but like right now we also have the whole inflation thing that you want to keep up with as well.
Yeah. But I mean, when I first started to buy my first 40 rental properties, it was in 2006 and 2007. Right. I didn't have a whole lot of reserves or capital sitting on the sidelines to buoy me if I ran into trouble.
Yeah.
Right. I needed the assets to keep me out of trouble. And so when you're talking about rents continuing to come in and, rental rates still staying high, that's what I experienced during the Great Recession. Right. Rent rates in Jacksonville did not go down over the Great Recession. Right. And that's the only reason I was able to own those assets, that I still own those assets, that I've been able to add more. It's because the assets pay for itself, because this is such a consistent asset class, even when the economy is going through tough times.
But Greg, right now, interest rates have just gone up. Is it still a good time? Like, so, interest rates where they are right now, that is tough for real estate. What about the timing when it comes to interest rates?
I think we're all a little bit spoiled when it comes to interest rates. If you look over the last 30 years, right, the average interest rate on a 30-year fixed rate mortgage is 7.8%. When I first started to invest in rental properties 17 years ago, my interest rates on my loans were 7.5%, 7%, even 8%. And I thought that was fine, right? So I know right now interest rates have gone up from the threes as they were being advertised to many of you, to now they're in the sevens, right? And we all have sticker shock. I get that. But I think it's a time for you to put your investor hat on. And regardless of what interest rates are just an input into this equation for you, right? If the entire equation for owning a rental property is a better risk-adjusted return than the entire equation for owning stocks or bonds or whatever other asset you're considering, then you need to put the investor hat on and make the best decision for that entire equation, right? Don't just be scared off on interest rates. Like, another way of saying this, stocks don't give you the opportunity to take out debt, right? If stocks gave you the opportunity to take out debt, the interest rate you'd have to pay on that would be way higher than 6 or 7% or whatever it is right now on real estate, right? Don't use the reason that real estate is an advantage, that it gives you the access to debt. Don't use that as the reason to not take advantage of real estate, because stocks and bonds, you don't even have the opportunity to take out the debt, right? So look beyond just the interest rate here. Look at all of the equation here. And if it makes sense to you that the risk-adjusted returns are better in owning single-family rental properties than what you're already doing, then don't be afraid to move it into single-family rental properties.
That answer is a reminder that Gregg is not a timing guy. That being said, do you believe that interest rates in the short term are going to continue to rise or drop in the short term?
It's hard to say. It really is. We think that the Fed is nearing the point where they're going to hold, they're not going to raise interest rates anymore. Mm-hmm. That's the chatter that the Fed is saying. I don't know if that is that they're not going to raise the interest rates at the next meeting, or maybe it's one more quarter point increase. It's still up to be determined. There's still a lot more that goes into it, even beyond just the Fed raising interest rates. Mm-hmm. Like the premium that investors are requiring when they invest in mortgage-backed securities is a part of this as well. So without getting too into it, it's hard to know what interest rates are going to do in the short run. Okay. In the long run, we think they're going down. Yeah, because they've gone up so much here, and the Fed doesn't want the rates to be as high as they are.
So hypotheticals, right? So we don't know what they're going to do. When interest rates go down, what does the stock market do?
Well, when interest rates go down, that makes it less costly to run their business. Mm-hmm. So if it's in a vacuum here and interest rates go down, you would think that would lead to more profitability of the stock market. Mm-hmm. The challenge is profitability in the stock market doesn't always equate to stock price. Yeah. Correct. Right. I mean, there's that. And then you have to think about what would have had to have happened for interest rates to go down in the first place. Mm-hmm. Right. People miss this part of it as well. Well, when the Fed drops interest rates, generally what they're trying to do is to pick up the economy. Mm-hmm. So if you believe that the reason that they would raise interest rates is that the economy is down in a recession, mm-hmm. then what you, in essence, what you're trying to do is to breathe life into the economy and in the S&P 500 or in the stock market. So you probably already lost money there, right? Mm-hmm. So you got to think about not just the inputs of what interest rates are doing today and what's that going to affect. Look at the big picture, right? Right now, the cost drivers of a business have increased significantly by the Fed raising interest rates over the last year, right? Like 4 or 5% increases on every business in America. Like that is a substantial increase in cost, which decreases profitability. And those effects take 6 to 12 months before they're actually seen in the economy. So those effects are still coming. What that is probably going to do is to decrease profitability for companies, which will lead to less jobs, right? That will lead to less consumer spending, which will lead to a recession, mm-hmm. and likely won't result well in the S&P 500. And so those who still have their money in the stock market, I know you're saying, listen, I'm down 15% from where it was, a year ago. I'm just going to wait for it to jump back up. But the data is saying otherwise. Okay.
So what happens in the stock market when interest rates rise?
Well, we see what happens when interest rates rise, it decreases profitability for companies, and it takes a little bit of time generally, but ultimately what the economy is doing is it's constricting, right? Because it's largely been on fire for a period too long, and that's why the Fed raised them in the first place. So you probably made more money in the stock market in the times previous, but going forward, once they raise interest rates, that's a signal that you have upcoming pain.
Yep. So what happens in the real estate market when interest rates go down?
Well, so let's talk about the recession myth. Okay. All right. Big picture, right? So many people believe that in a recession, real estate prices go down, but that's only because they lived and remember the Great Recession, right? But if you actually look back in the previous 6 recessions, only one recession did real estate prices go down in Jacksonville. I'm just quoting Jacksonville right now. And it was the Great Recession. 5 out of 6 recessions, home values actually went up. Again, because what is the Fed doing? Well, when there is a recession, the Fed generally drops interest rates. The asset class that is most affected when the Fed drops the federal funds rate, and then long-term mortgages tend to decrease, right? The interest rate tends to decrease. The asset class that is most affected is real estate. Rates go down, demand comes up, and you generally see real estate do well. So the recession myth is that real estate values generally do not go down in a recession. So in a recession, generally rates go down and home values actually perform quite well.
What about when interest rates go up? How does real estate tend to perform?
Well, we're kind of seeing it right now. And the Fed is doing anything and everything it possibly can do to dampen the housing market because it's raised interest rates, right? 4 or 5% in the last 10 months. And home values are still doing quite well in many parts of the country, right? Jacksonville home values are still doing quite well. So home values are not decreasing this quarter, right? So, I mean, what else do you want to see as far as consistency and stability? This is the fastest rise of interest rates in 40 years, and home prices are still stable here in Jacksonville. So, you know, home prices do well when interest rates drop. Home prices do well when interest rates go up. It's this asset class at the core of it. This asset class provides so much utility, whereas other asset classes don't. It provides a roof over people's heads that people are still going to be buying this asset class as long as they need a roof over their head.
So if we're gonna move off of stocks versus real estate, we're gonna get more granular into real estate and timing the market. But if I was to summarize stocks versus real estate, timing the market, and interesting hypotheticals, I would first say GC, not a timing the market guy. That being said, if you were to dial in, so not a timing the market guy, and in general, real estate has a better risk-adjusted return over stocks.
Mm-hmm.
Now, if we were to dial into where the market is right now and what we see in the forefront, right, in the horizon, seems to be a recession coming. There is a high chance that stocks drop between 20 to 29% in the near future. There is a very, very high chance that real estate stays consistent / goes highly up in those conditions because rent doesn't drop. You stay in a cash flow performing asset class, you preserve capital, you turn equities into income instead of taking a beating in the stock market. And then on top of that, with fluctuations of interest rates that we know are coming, whether they're going to go up or they're going to go down based on all the stuff that's happening that's funky, stocks tend to also react more volatilely to that while real estate stays pretty consistent. So whether it is not a timing guy or timing right now, real estate still seems to be a better risk-adjusted return.
I think this is the perfect time to look at how you're allocating your wealth. If nothing else, have that conversation with yourself and with a trusted provider of financial advice for you. Because if you have everything in one asset class right now, regardless of what's happening in the market, you probably should have had that conversation at some time. And you probably should have reallocated, put a third, or 50%, 50%, or whatever it is. This is the perfect time to have that conversation. And if you want to move to a more consistent asset class, moving into single family rental properties, there's not a better time to do it.
Yeah. And by the way, if your financial advisor is not giving you really great advice on it, it's generally because they're not educated on this stuff, right? Like we've had our favorite fiduciary fee-based financial advisor, Kelly Barenbaum, on the show. So if you just kind of want the questions to ask or how to have this conversation with your financial advisor, go to chatwithjwb.com, just hop on a call. You know, that's the great intro calls. Like you get to just ask all your big questions and you get some advice to know what questions to ask going forward in other conversations. That being said, we're going to move on to the next conversation. When it comes to timing the market, does home price appreciation matter when it comes to these like different markets, right? And by that, I mean, you know, Jacksonville's been doing its thing over here. Cleveland's been doing its thing over there. Dallas has been doing its thing over there. There's a couple other markets. GC, when it comes to timing the market and picking which real estate market you want to move into, how do you think about that?
Well, I think it's incredibly important to pick the right market. And at the same time, it's almost like you have the answers to the test, right? You can look and see which markets over the last 40 years have seen more home price appreciation. And if you start to analyze how home price appreciation works, it's cyclical. The same type of appreciation rate you've seen over the last 40 years is largely what you see over 10 to 20 year segments of time as well. And so that's why I say it's almost like you have the answers to the test, right? I've got the answers right here. This is what I printed out. This is what we share with everybody who, you know, jumps on a call with our team, right? We go over and we say, well, this is why you choose a market like Jacksonville. Jacksonville's home price appreciation is 25% higher than the average of comparable cash flow markets out there. And the reason that that matters for you with your portfolio is if you choose a market that has above average home price appreciation, it's going to lead to an additional hundreds of thousands of dollars in your portfolio over a 10-year hold. And if you want to put 3 properties in that portfolio, or 5 or 10, literally choosing the right market can easily become $1 million decision for you. Either you choose the right market based on the data of how it's performed over the last 40 years and you make the right choice, or you choose another market that doesn't grow as much and you potentially leave hundreds of thousands of dollars, if not millions of dollars on the table, because over the next 20 years, guess what? Those same market winners are probably going to perform better over the next 20 years as far as home price appreciation. And the same market losers are still going to perform that way as well, absent of some huge foundational shift.
Yeah. So that being said, you want that historical appreciation to work in your favor, right? Like you want to move into these growth markets that mitigate risk because they have growing populations, because they have at least 1 million inhabitants, right? Like what I remember a lot from timing the market in the Great Recession was the idea that these like towns that popped up out of nowhere became the hardest hit and have been the hardest to recover, right? While like the ones with well-balanced economies have generally bounced back and done really, really well and didn't suffer as much, right?
Yeah.
One of the things that I learned while we were recording the class that you can go take at nyaiclass.com, and it's free for at least a limited time right now if you use NYAI Guide free, is the idea that right now people are using these like recent numbers of home price appreciation. So maybe a market just hit a heater in the past couple of years, and now they're trying to project that that's what's going to happen. How do you feel about that? When it comes to like evaluating based on like what the market has done over the last 3 years, one market to the next, how do you consider that when it comes to timing?
Yeah, I'm not surprised that a lot of operators and those who sell investment properties are using the most recent year's data. It has become harder to put evaluations in front of investors and make the numbers look good over the past few years. And so when that happens, you know, operators tend to use pie in the sky numbers for things like home price appreciation or rent price appreciation, right? I was just on the phone with a potential client the other day, and they were telling me about how their evaluations said they were going to get 6% home price appreciation year over year in the Dallas market. And I was like, well, how'd you get that number? And they're like, well, I don't know. That's what the provider said. I said, well, how do you think he got it? I was like, I've got the numbers for Dallas right here. I said, you know, Dallas's home price appreciation over the last 40 years is actually 4.2%. That's what the average has been. I was like, it's only reached 6%. I think it was 12 out of 40 years. Right. And a lot of those were the last 3 years. So do you want to base your entire decision on you being one of those, you know, 12 and really 9 absent the last 3 years, you know? So I think it's pretty, you know, it's not unexpected, but I think it's really important that everybody can separate the recent past from the long-term historical past. Just like I'm not a market timing guy, I'm also not a guy who's going to use the last 3 years of data to make another 20-year decision, right? Because what happened over the last 3 years, nobody saw it coming, you know, to that degree. And at any 3-year period of time, the next 3 years, I don't know exactly what's going to happen, but I do know what's going to happen over the next 10 to 20 years, right? So yeah, I think it's set up for a lot of people, unfortunately, to make poor decisions and to be guided in a poor fashion, frankly, because the appreciation numbers that other operators are using and rent price numbers and rent appreciation numbers that they use are just not based on data. It's pie in the sky numbers.
So if I'm hearing you correctly, GC, when it comes to timing the market and you're thinking between one market or the next, you want to lean towards historical averages and not recency bias, because what the behavior does when people are offering you investments is they try to paint it as pretty as they can, right? So they're going to use the best kind of like data set, and especially if it's recent, then they can like tell you that makes more sense because this is a new normal. But the data shows that new normals are generally just normals,
Mhm.
right? Like
Yeah.
it goes back to normal. And these blips in higher appreciation, just like at sometimes it goes a little slower than normal, right? Like it'll
Mhm.
still grow, but it'll grow slower than normal. It tends to stay within the average over market cycles for the majority of markets all the time.
Exactly.
Okay, so just to make it clear, not a timing guy, but when we dig in a little bit deeper here, this actually makes sense of not really going with recency bias of supercharged market appreciation, a certain thing. You want to look at a full market cycle, 40 years of data, 20 years of data, something like that, normalize it. And that's what you should expect, or else you're going to set yourself up for underperformance.
Yeah. I mean, and for all of our friends who join on Thursdays when we do the property of the week, right? Our number for home price appreciation hasn't changed, right? Our expected home price appreciation in Jacksonville has been 4.6% for years now.
Mhm.
Even though I have the data that shows that it's been a lot higher over the last 3 years,
Yeah.
right? It's been an average of like 15% over the last 3 years, right? But I'm not using that data. I'm not ticking it up past 4.6%. You know, part of that is because I know what the historical trend is, and then part of that is because I want to underpromise and overdeliver. But everybody else out there doesn't think the way we do. And, you know, I'm not saying anybody's right or wrong. This just happens to be our approach. But the way that it affects you is you might be overstating. You might be making a decision expecting X number of returns based on 6% home price appreciation, when in reality, the chances of you achieving that are really small. And I think that that's a shame for a lot of folks out there.
There you go. All right, GC, let's move into, all right, so you're convinced, you're inside the real estate space, you're convinced of a market, right? Let's talk about timing the market when it comes to specific timing of a specific market. The thing that we hear a lot in Jacksonville, for example, I'm sure you hear this in other markets, is prices are so high, I'm waiting for the next dip to get in. You know, prices are high, interest rates are high, I'm waiting for the next dip to get in. Does that make sense to time the market when in that regards?
You know, I'm not a timing guy.
Oh, no, I did not. I was just recently made aware of this.
No, and I won't regurgitate what I just said, even though, you know, that's what I believe. But even if you were a timing individual, right, I still don't think it makes sense to wait, right? If like now I'm putting on my timing hat, right, and I'm looking in the S&P 500, I'm looking at what bonds do in recessions, right? You know, we haven't talked about bonds, but when you're in a recession, generally the Fed drops the Fed funds rate, which drops the yields on bonds. So bonds go back to performing next to nothing as well. So neither stocks nor bonds tend to do well in recessions. And then on the real estate side, there's so much data to show that it performs consistently. But then think about, you know, do you believe that in 3 years from now, in theory, we would be beyond whatever recessionary time we have going on right now? Do you really believe that in a growing population like Jacksonville, with so many things going for it, the fact that we have more home sales in a month, even right now, than we ever had prior to 2020, right? We have over 300 or over 3,000 home sales happening right now, these months, and we never even got to 3,000 home sales until the middle of 2020. Do you really believe that home prices are not going to be higher in 3 years than they are right now? Right? Run this through your analysis. If we are going towards a recession, and if you believe in recessionary times, the Fed drops the Fed funds rate, which tends to lower interest rates, and you believe that when interest rates are lowered, home sales tend to go up, which would lead home prices to go up. Do you really think that that cycle is not going to happen here?
Yep.
If you believe that that cycle is going to happen, then no matter what happens for pricing over this year or next year, call it in 3 years, you would lead yourself to believe that home prices are going to be higher than what they are today, no matter what happens in the short run. So if you're investing for the long haul in an asset like this, then home pricing in the short run really doesn't make a difference, in my opinion.
Yeah.
But what does matter, if I'm putting my timing hat on, is in the short run, what's going to happen in the stock market. I'm not convinced that, you know, over the next 3 years, you wouldn't experience a significant amount of pain, and who knows what the rebound would be after that.
Yeah, I keep going back to my conversation on that morning run with my other friend named Greg that I run with.
Man, you really know how to make me jealous.
Greg Buckland, when he was just talking about this idea of, you know, I had this aha moment of investing has to do with the wealth you want to create. And if you want to create that wealth, the short term of it needs to have this like lay my bed and pillow at night kind of thing, so that it's not affecting your quality of life while you're in it. And what I think is similar to what you just said. Yeah, interest rates might be high and prices might be high, but I am pretty sure that interest rates are going to lower in the future and prices are going to be higher. I'm also pretty sure that by the time that the interest rates lower and everybody rushes back in, prices jump really, really quickly. And the price that you bought at today is going to get even more exaggerated higher of what you're going to have to buy tomorrow. And then in the meantime, whatever you're doing with your money, it's going to be going on this roller coaster ride, right? Like it's going to be doing this like up and down thing if it's not in this like cash flow mitigated, capital preserving asset.
Mm-hmm.
So, if it's do I time the market right now to get into this thing that I believe in? Do I believe in whatever city you're investing in? Do I believe that it has the right trends of growth? Do I believe that it has a well-mixed economy? Do I know that I can get into a break even and or positive cash flow situation no matter what when it comes to the investment side? Then it is better to get in now at this higher interest rate, write it out, and know that you're performing better than other things. And then when interest rates drop, refinance.
Just refi.
And you've had the gain, you've had the gains that have already happened. You haven't lost it on the other thing.
Mm-hmm.
And to boot, the preferred lenders that JWB works with have created this thing of like, you can buy today, refinance tomorrow for free, right? So like, that is something we've talked about other shows, but if you want to know more about that program, go to chatwithjwb.com, hop on a call, but essentially you can buy something right now, refinance for free in the next 3 to 5 years or something like that.
Absolutely.
And
whenever rates go down.
When they go down.
That's the beautiful thing about the smart debt that we have available to us here in this country, and specifically with the JWB lender network that we have. There's no prepayments penalties, right? So don't let the sticker shock because interest rates have gone up so much in the last year dissuade you from investing in a great asset, which, oh, by the way, you can just drop those interest rates as soon as rates come down at any point in the future.
Correct. So that's that to me. It's like, does it make sense to time the market right now? I think if you're already convinced of a market, let's say it's not even Jacksonville, right? Let's say you want in on this other market, you believe it's going to grow, you can get positive cash flow. Number one, you have a good team that can deliver on the data that they're giving you, and you can probably source another lender that's doing this in that market as well. If they're doing it here, they're doing it there.
Yeah.
Right. So like whatever you're convinced of, I believe that the getting in on it now, when it comes to the timing the market equations, specifically, you want to time it this way because of the put your head in the pillow at night if you're going to do it versus your other options.
I completely agree. Right. This is a peace of mind move as much as it is and a better risk adjusted return on investment move.
True.
You're not getting much peace of mind in the stock market right now.
Yeah, makes sense. I'm going to throw a little curveball at you, GC, because our community asks great questions. David Plattner just asked a great question. And, let's say we are in real estate and we're not just comparing market, we're comparing between asset classes and you're comparing between syndications of multifamilies or single family rental homes. The way that he put the question, hey, will the difficulties that some multifamily syndicators are having due to their spiking borrowing costs affect anything that we talk about? Can you just talk about timing the market when it comes to syndications right now versus single family homes?
Yeah, and this is a great topic. In fact, Pablo's dad just sent an email to us, which is somewhat related to this. And he was talking about, he asked if JWB was a syndicator because the Wall Street Journal was just talking about how spiking borrowing costs or syndicators have really increased the risk profile. And so he asked some questions about us. So what I was able to share is that the debt behind syndications is completely different than the debt behind owning single family rental properties. And not only is there risk because they're spiking borrowing costs for syndicators, whether that's multifamily, office, any type of syndicator, real estate syndicator out there, there's more risk because borrowing costs have gone up, but you also have to look at how those loans are structured. Single family loans are the only ones that are built out for 30 years, that you can keep those in place for 30 years, that you don't have to make additional capital calls, right? That don't have prepayment penalties. When you get into financing for syndications like multifamilies, commercial for sure, the structure of the loan is very different. Think that you have loans that are due in 3 years, sometimes 5 years is very, very normal, sometimes 7 years. And all of that capital is due back to the lender in 3 years, 5 years, 7 years. Well, a lot of these syndicators, multifamily and other syndicators, raised all that money 3 years ago, 5 years ago. And so right now, their loans are coming due, which is creating a big challenge for those folks. As well, you have to think about the asset value. So as I talk about how consistent asset values are in single family rental properties in a growing population like Jacksonville, that's not the case for office right now, right? In office values are down over year, right? They're down like 20%, right? So when that happens and the loan is coming due, that syndicator has problems because they can't just go and refinance and get into another loan, because they would have to bring a significant amount of capital in order to do that. And oh, by the way, they've probably been having challenges over the last year anyways, because borrowing costs have gone up. So they probably don't have that capital. So the answer to your question, David, is we're adjacent here. We're adjacent because we focus on good old single family rental properties. We are not a part of this type of capital structure. And so we're adjacent to it. The borrowing costs are going up, but I think the bigger thing to pay attention to, which many people aren't aware of, is the structure of the loan. And when is that capital due? And is there enough equity in that loan to refinance or to do something to be able to protect that investment for their investors?
So to restate David's question, will the difficulties that some multifamily syndicators are having due to their spiking borrowing costs affect anything that we talked about? The answer is no, it's not going to affect the single family home with a 30-year fixed mortgage.
It's not going to affect you as an individual investor. If I wanted to kind of piece together how this could affect all of us, because everything's related, right? There's no investment that's in a vacuum anymore. But I think if there was such a crash in these other asset classes, because a lot of the structure of the loans, like I'm talking about, and the lack of equity in a lot of these asset classes, if there was such a devaluation of assets that lenders got skittish, and not only did they say, oh, well, we're not going to lend on multifamily, we're not going to lend on commercial, we're not going to lend on office like we used to, but that they also would get skittish about lending to single family because of that, then I think that could affect our asset class. But that's so many steps along the way here, there. So I don't think anything is completely insulated, but I think I like the term adjacent. We're adjacent to it all.
Is it fair to say that if those asset classes suffer and people are inevitably going to be looking for somewhere to put their money, that maybe it actually has a positive effect on single family homes?
Definitely think so.
Okay. Yeah. All right. So then if I was, so then when it comes to timing the market and it comes to syndications, it does feel like right now is a particular time it's a little bit riskier to invest in in syndications because of the debt structure in syndications and the uncertainty in the short run versus single family homes, certainty in the short run, because it's a fixed debt.
The loan is so beautiful on the single family side.
Okay. That's
30-year fixed rate loans, guys. I don't care if it's 6% rate or 7%. On our evaluations, actually, we're able to get 5.5% rates for everybody. So it's not nearly as bad as everybody else says. But if it was 6.5, it was 7, you give me a 30-year fixed rate loan to borrow money at 7% on an asset that performs 12% year over year, take that all day, every day.
All day, every day.
And twice on Sunday.
Twice on Sunday. All right, GC. Good stuff, man. Now I'm going to ask you with a question that we all really, really want to hear, which is, you have proclaimed yourself to be not a timing the market guy, but what would have to be true for you to be pumped to time a market?
So I thought about this. Pablo prepped me for this ahead of time. So truth be told, he's like, all right.
Well, I just, if we invited people to like a conversation where you're just going to say, I'm not a timing the market guy all day long, it would have been pretty freaking boring. So I needed you to come up with something.
So in order to come up with something, like what would make me say, listen, this is the best time in the history to invest in Jacksonville real estate? Well, it would need to be something that would shift that line from 4.6% home price appreciation to 5% home price appreciation. Because and I'm just throwing that number out there, but if you got an extra 0.5% of home price appreciation on a $200,000 to $300,000 asset over the next 10 years, that equates to, again, tens of thousands of dollars of additional return on investment, right? So it's not such a question of like, why would this be the right time? It would be what activities or what investment or what things would be going on that would shift that line from 4.6 to 5. And when I think of the thing that would shift it from 4.6 to 5, it's downtown Jacksonville, baby. It's downtown Jacksonville. So I put some stats here. And I think these stats, even when I put these stats together, they really surprised me. I fired it out to Pablo. I sent it out to Madison. I sent it out to our entire sales and marketing team because they just kind of epitomized what I know is happening in Jacksonville downtown that very few other people see. So I went back and I looked over the last 10 years and I saw the data for the number of completed development downtown projects, the number of projects that are under construction, and the total investment downtown. And what we're seeing is from 2013 to 2022, the landscape is completely changed. Now in Jacksonville, you don't actually see all of the buildings that are currently being constructed yet. They're not all open and performing yet, but the hard work has been put in, and that's reflected by some of these numbers. So I don't know, I can kind of get granular with some of these numbers. What do you think I do? Do you think I just spout them off? What do you think?
I think you just talk about what you're pumped about, man.
Well, I'm pumped because I think that this could shift the line. And you're not going to see it in the evaluation that I'm going to put in front of you. You're not going to see me jump it from 4.6% home price appreciation. But this is my under promise and over deliver moment for our investors. It is the growth of downtown Jacksonville, and beyond any other market timing reason. That's the urgency. That's the realization, because if you look at other successful downtowns like Tampa and Nashville, the moment that the numbers work to the moment when rents start increasing in the surrounding neighborhoods and the home prices start increasing in the surrounding neighborhoods is very quick.
Yeah.
Right. I'm actually putting data behind understanding how quick that jump is, because I know it's quick. And that's that window, because if you try to go to Nashville right now and try to buy single family rental properties around downtown, good luck.
Good luck.
You used to be able to do it 5 minutes away, 10 minutes away from downtown. Now it's a whole lot longer. You're a lot farther away from downtown because home prices and home rents have gone up so much in the surrounding areas to downtown. So this is the big opportunity, I think, to time this. If you want me to talk about timing, it's this opportunity to shift the market, to shift from 4.6% in Jacksonville to over the next 20 years, maybe it is 5%. And there is not a bigger opportunity than downtown Jacksonville. And that's a big part of why we have gone so big with our investment, JWB's investment in downtown. I mean, that's why we bought the equivalent of 20 city blocks.
Yeah.
Because we see this as a huge opportunity for our community. We see this as a huge opportunity for all of our investors who own 3,000 rental properties right around downtown. And then we see it as a big long-term opportunity for us to make an impact as well.
Yeah. And, to kind of like frame it from my perspective, I've seen this, right? Like I saw this happen in Miami when downtown was nothing and it was only really bad neighborhoods around downtown that you wouldn't want to be in downtown, and you sure as heck would not want to be in the neighborhood surrounding downtown. Right. And now those things are going for millions of dollars.
Yep.
And it was super quick. And the people that lived there didn't really realize what was happening, right?
Yep.
Like the people that live there, like, what? You're gonna pay $300,000 for this thing in Overtown,
right? And
now developers are spending millions of dollars for those plots just 6 to 8 years later, kind of thing, which is insane.
Mm-hmm.
And it's because of this like densification, right? And to me, the really unique thing about it, GC, that you don't mention in this, is that this only happens once in a city, right? And it doesn't happen. It's not guaranteed to happen for every city.
Mm-hmm.
And it only happens once, right? So like the idea that you have a city that ahead of the rest of the world, including the residents of the city, that has all this groundswell happening behind the scenes, that you are tied into the person that actually is responsible for a large deal of the groundswell behind the scenes and is bringing in a coalition of the willing to do this stuff behind the scenes. And now these numbers are slightly moving from behind the scenes and in front of the scenes in our little community here, but to in front of the scenes slightly outside of this community here, but not yet tipped. Having that access to me might be the most valuable access I've ever gained in my life as a guy who's obsessed with access.
Yeah.
Right. And just your numbers, right? The idea that completed development from in the last 5 years in Jacksonville has jumped 64%. And in the last 10 years has jumped 2,549%. That's pretty eye-popping, right?
Let me give you a little bit of numbers there.
Yeah.
Because in 2013, all of downtown Jacksonville completed $9 million of development. In 2022, JWB, just ourselves, we've completed 20 million, just us. So that's double what the entire city did in 2013.
Yeah, that's a big deal.
Just in 2022, as a city, it's not 9 million of construction. We did 263 million. This is not proposed. This is not even under construction.
This is receipts.
Like done.
Yeah, receipts.
Right? Like stuff is happening here. Right? And then the under construction number is the one that I really wanted to pay attention to. Right? In 2013, we had 470 million under construction in downtown Jacksonville.
Sounds impressive.
Sounds impressive, right? Until you consider in 2022, we have 4 billion with a B going on right now.
Yeah.
This line item, I think, is more significant than anything else because this means money is already being spent. It's right. Properties are not being taken down. Properties are being renovated or right.
Rehab, developed, redeveloped,
right.
Activated.
Activated, right. This is like sometimes you can give these big glowing numbers and it's people just like big developers saying, oh, I want to do $1 billion here. And then that can be categorized as something that's called proposed. No, this is under construction. We went from 470 10 years ago to 4 billion. Here's even more impressive. 5 years ago, the number was 719 million and it's 4 billion now. I think that is the biggest indicator of where Jacksonville is. And this is why all these other big market players are looking at Jacksonville and they're coming to downtown and they're coming to our city. So I'm going to keep sharing these numbers with you guys because it's beyond just what I think. It's beyond just like where I'm putting my own money as far as downtown. It's this type of an effect when you can have a 5 or a 10x effect in the amount of construction that's happening in it's only 3.9 square miles.
Yeah.
We're talking about here, 4 billion.
Yeah.
Like I was just in DC and in all of DC, which we think is this bustling city, they have 1 billion going on right now. We have 4 in Jacksonville.
I'm pumped about how this content is going to age.
Yeah, I am too.
Right? Like I feel like this is kind of like the big short guy calling it and blah, blah, blah. And then nobody believing him and it happening and then being able to pull the receipts years later.
Yeah.
Like I honestly think that this is the stuff that I think is going to project you into like a different stratosphere of what your profile level is, right? Like I think when we first started this show 3 years ago, I was like, I think that you're the Richard Branson of real estate, right? And I know that was super, like a super reach, right?
Yeah.
And I don't think that this stuff moves in a linear fashion. I think it becomes exponential. And I think that over the last 3 years, you have gotten COVID right before everybody else. You've gotten, you've gotten these headlines that keep happening all the time before everybody else. I think this big one and the ability to pull back to the receipts of today, May 30th, 2023, and you're just going to look 3 years ago, in the next 3 years, what's going to happen in downtown Jacksonville and what Jacksonville is going to be seen from a global perspective and from a real estate investment perspective. And people are going to look back and be like, oh man, you're the Nate Silver of Jacksonville, right? Like you're the guy that called this whole thing and you're going to be speaking on the big channels and all this type of stuff because you've been on it before everybody else. Like I really do believe that this is from the way that we talk about things, right? Not a timing the market guy unless there is a black swan event that we all know is going to happen, right? Like having an inside track on a positive black swan event is maybe the most valuable opportunity you're ever going to have. And on top of that, when you think about it, right? Like people that don't understand what's going on here in this little community are like, oh, okay, how do I go invest in a downtown Jacksonville? They don't realize that it takes much less. It's much more risk mitigated if you know that you have a team that can handle an asset inside of a city that's going to pop and a way to like buy it and not have to do it yourself, that you can count on these numbers going forward. I really think that it is a historic opportunity to like know that a city's downtown is about to happen, to know that all these tailwinds are coming, and to have access to a way to invest for under $10 million. You know, like absolutely. I just think it's huge.
Like our passion has always been serving the everyday investor. And I don't think there's a better time for the everyday investor who's a busy professional to hitch their wagon to a growth agent like a downtown revitalizing amongst a growing population, which has done quite well, even if downtown wouldn't grow, right? And all of those levels there are just risk mitigation for me. Risk mitigation, right? So
and to do it without having to change the rest of your life to do it.
Yeah,
right.
exactly.
Like I think this is the type of opportunity that people will move from somewhere to this market to capitalize on it. In this market specifically, you don't have to do it because there is somebody that's willing to serve the everyday person. Yeah, I think it's badass, man. A couple of questions here. Gerard Wendling is asking, how big of a radius miles around downtown do you think this will affect?
I think it's going to affect the neighborhoods that we put you in, which are all kind of 10, 15-minute drive from downtown Jacksonville. You know, downtown is in the heart, but there's the north side, there's the west side, there's south side, and there's Arlington. Those are the 4 neighborhoods, and they're surrounding downtown right now. It's like this is working perfectly with the master plan for JWB, which has been in place for 17 years.
Yep. And Vonda Lynn asked the question, do you have lenders that loan to self-employed, such as a DSCR lender? And if so, at what rate?
Hi, Vonda. The simple answer to your question is yes, absolutely. We do have lenders that lend to self-employed folks. We have DSCR lenders as well. The rates, I would encourage you to jump on the phone with my team. So this is where you can go to chatwithjwb.com, or you can just send a quick note to Madison and we can get you set up for a phone call to get into answers on things like rates and even beyond that, right? Things of putting a plan together for you to make sure that your assets are growing with us.
Yeah, Vonda, great to have you. New name.
Welcome.
Welcome to the community. Welcome to the community. So you can DM Madison, who's our community manager. She's in the chat right now. Or if you're listening to this later on in your life, go to chatwithjwb.com and you can get answers to those questions. GC, this was fun, man.
It's great, man. I just love these. I love these chats, man.
This is fun. I like prying your head open in public and seeing what happens.
You know, if you had asked me a few years ago if I'd be comfortable just kind of sharing my thoughts in a forum like this, I would have told you you're crazy. But this is such a welcoming community. And I just think, you know, it's fun to get it right a few times over the years. It gives you confidence that, you know what you're talking about. And then it starts to change the lens from like, stop being so scared to how can I help people make better decisions? And so I appreciate everybody in the community for helping me go along that path. I really believe some of the information that I have access to can help you, especially in tough economic times like we have in the country right now, and unfortunately that we're on the doorstep for. So I appreciate all of you. It's been a nice journey. You
know what I see, man? I see a little Richard Branson coming out right here. Little Richard Branson on the TV.
Stop it.
All right. I want to thank the community for being a part of this. Again, if you want to just catch up to, we talked high level right now. If you want to know the nuts and bolts, the basic concept of all this stuff and really understand it. So whether you're doing business with JWB or anybody else, you know the right questions to ask. If you're going to try to build passive real estate, there is no better time than ever to pick up the class that we just created. It is very current because we just finished it, and it happens to be free for a limited amount of time. If you go to nyaiclass.com, it's available there. And for a limited time, you can get it for free. When you are checking out, it has a little coupon code thing. You click on that and you type in NYAI guide free, and it should zero out the $997 that this class is going to go for. It's going to be an awesome experience. It's a lot of fun. You will giggle throughout the class and you're going to learn a ton, I promise. So go check that out. I want to thank the community for being a part of this. You have the best questions. You add the best context. You make Gregg feel like he is comfortable enough to become Richard Branson one day. And thank you, GC, for giving me this platform to be a part of all of it, bro.
Thank you, guys. This is awesome.
So want to see you on Thursday when we go over the actual current Jacksonville inventory that you can invest in that allows you to take part of this growth of downtown on the weekly JWB week. And until then, just know, if you want to think the right way about whether you should time the market and interest rate hypotheticals, you can't think like an average investor. See you Thursday.
See you.